You open your portfolio app. Your heart does a small private calculation. Green means you're a genius. Red means you're an idiot. You feel certain in that moment that your choices are yours alone. But the real answer is far stranger. You are not really making a choice at all. You are performing a role that millions of other people are performing at the exact same second, in the exact same way, for the exact same reasons. Here is the strange part. There is a mathematical sense in which every investor on Earth is secretly the same investor. Not emotionally, not in personality, but in outcome. Add up every single share, every single dollar, every single trade made by every single person in the market, and you get one number. That number is the market. And here's the twist. Before costs, the average investor earns exactly what the market earns. Not more, not less, exactly. This is not an opinion, it is arithmetic. In 1991, the economist William Sharpe published a short paper called The Arithmetic of Active Management. He wasn't trying to be provocative, he was just doing the math. Sharpe pointed out that if you divide all investors into two groups, passive investors who simply hold the whole market and active investors who try to beat it, then before fees, the active investors as a group must earn precisely the market's return. Why? Because together, they are the market. You cannot beat yourself. Sit with that for a second. Every hedge fund manager on a trading floor in New York, every retiree checking stocks from a kitchen table, every teenager buying a single share on an app. Together, mathematically, they are one organism. And that organism cannot outperform itself. So why does everyone believe they can? This is where the story gets human, because knowing the math doesn't stop the feeling. In the 1990s, two researchers, Brad Barber and Terrence O'Dean, got access to the trading records of over 60,000 households at a discount brokerage. They wanted to know something simple. Did people who traded more often make more money? The answer surprised almost no one who studies human behavior and shocked almost everyone who trades. The most active traders earned the lowest returns, not slightly lower, dramatically lower. The households that traded the most underperformed the market by nearly 7 percentage points a year. They weren't unlucky, they were confident. And confidence, it turns out, is expensive. Barber and O'Dean called their paper, "Trading is Hazardous to Your Wealth." The title alone tells you something about human nature. We don't trade because the evidence says trading works. We trade because it feels like doing something. Feeling in control and being in control are two very different experiences, and your brain has trouble telling them apart. Now here's where your ancestors walk into the story, uninvited. For most of human history, action was survival. If you heard a rustle in the grass, freezing was sometimes fatal. Moving, checking, reacting, that kept you alive. Your brain was not built in a boardroom. It was built on a savanna, where doing something usually beat doing nothing. That instinct didn't disappear when humans invented stock tickers. It just changed clothes. The same circuitry that once told a person to move toward a sound now tells a person to move toward a chart. Refresh the app, check the number, react to the dip. It feels ancient because it is ancient. This is why you don't just have a portfolio. You have an argument happening inside your skull, between a very old brain and a very new financial system. The psychologist Daniel Kahneman spent decades mapping this argument. Alongside his collaborator Amos Tversky, he showed that people don't evaluate outcomes the way classical economics assumed they would. Losses hurt roughly twice as much as equivalent gains feel good. This asymmetry has a name: loss aversion. It explains why a 10% drop in your account can dominate your thinking for a week, while a 10% gain barely registers after a day. Your nervous system is not weighing the numbers fairly. It never was designed to. And loss aversion doesn't just live in your own head, it spreads. When markets fall, people don't just calculate, they watch each other. If your neighbor is selling, Some ancient part of your mind whispers that they know something you don't. This is herd behavior, and the economist Robert Shiller spent much of his career studying exactly this pattern. In his research on speculative bubbles, Shiller argued that prices often move not because of new information about the future, but because of a kind of social contagion. One person's fear becomes another person's evidence. Multiply that by millions of accounts, and you get a market that swings not on facts alone, but on the echo of everyone else's emotions bouncing around a shared room. So picture it now. Millions of individual investors, each one certain they are thinking independently. Each one checking prices out of the same ancient instinct to monitor threat. Each one feeling losses almost twice as intensely as gains, exactly as Kahneman and Tversky's research predicted. Each one glancing sideways at what everyone else is doing, exactly as Shiller described, and mathematically, exactly as Sharpe proved, together forming a single collective entity that cannot beat itself. You are not one person making a free choice. You are one node in a very old, very large, very predictable pattern. Here is the counterintuitive twist. Knowing all of this should make investing feel less personal, and that should be a relief. If the market is not a battlefield where clever people beat foolish people, but an ecosystem where the average outcome is mathematically fixed, then the entire game changes. The goal is no longer to outsmart 6 billion other decisions happening at once. The goal is to stop fighting your own nervous system long enough to simply stay in the room. This is why the investors who tend to do best over long periods are often the ones who do the least. Not because inactivity is clever, because inactivity is honest. It admits that the ancient alarm system in your head is not built for quarterly statements. It is built for rustling grass. Think about what this means for the number on your screen today. That red or green isn't really judging your intelligence. It's measuring how well you're managing a brain built for a world without stock markets at all. Every time you resist the urge to react instantly, you're not being passive. You're overriding millions of years of instinct with a few decades of evidence. So the next time you feel that jolt of certainty, that sense that you alone have spotted the pattern everyone else missed, pause. Somewhere else in the world, someone else is feeling the exact same certainty about the exact opposite trade. Multiply that feeling by every account on Earth, and you start to see the shape of the whole organism you belong to. You open your portfolio app again. Your heart still does its small, private calculation, but now you know the truth hiding underneath it. You were never really alone in that decision. You never really made it independently at all. You were just one heartbeat inside a single, ancient collective creature, still checking the grass for movement, still mistaking motion for meaning.